On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. Before you make any decisions, we recommend you contact an investment advisor. For more information about our services in that regard, or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all doing well. Today I wanted to talk about expected returns over the next 10 years. Now, let me say from the beginning that predicting investment returns is not easy. Nobody can do this with accuracy, regardless of their experience, their intellect, or the resources they've got behind them. But when you do see someone put together the collective crystal ball gazing from some of the world's leading investment firms, that is worth a look. And that is exactly what Horizon Actuarial, which is a US-based firm, does every year. So I was really interested in how the annual survey of capital market assumptions looked this year, 2025. Now, this firm has collected and compared all of the long-term return forecasts from some of the real global heavyweights, names like BlackRock, Vanguard, Goldman Sachs, JP Morgan. They surveyed 41 firms, and all of those companies have used a different range or type of methodologies to come up with their estimates, but the results provide a really interesting snapshot of what professional investors are expecting over the next decade. A really clear message is that the days of double-digit returns might be behind us, at least for the time being. The survey's consensus view suggests that US shares will return 6.4% per annum over the next decade. Now, that's not a terrible return if the inflation rate averages 2.4% over that same period, as this group suggests. That would be a real return of 4% per annum. Not terrible. However, that would be a far cry from what many of us have become accustomed to in recent years, because US shares, and I'm looking at the S&P 500 index in the US, that has delivered an annual return over the last decade of 14.6% per annum. Now, that is more than double the 6.4% that the average forecaster, or the average of these forecasts, sees coming in the next decade. Now, in part, that strong return we've seen over the last decade is due to the gains very recently. It's been a very strong last 2 or 3 years, hasn't it, for US share markets? Now, that same disparity in terms of the expected return versus the last 10 years, that isn't expected for other parts of the world. When you look at developed markets outside the US, so that will be the likes of the UK, Europe, Australia, Japan, all put together. New Zealand will be in there somewhere too. That group is expected to see a stronger gain of 7.2% per annum over the next decade, while emerging markets, so this is China, India, Indonesia, Brazil, all of those developing or emerging regions, that group is expected to see a return of 7.6% per annum over the coming decades. So you've got the US at 6.4, the rest of the developed world at 7.2, and then the emerging world at 7.6. And those last two, the numbers aren't terribly different from what we've seen from those two regional groupings in the past 10 years. However, as we all know, the US is the world's biggest economy and it's the world's most dominant share market. The US represents more than 60% of global share market indices. And that means that a more modest path of returns from the American market will easily overwhelm the more regular gains from non-US shares. Now, it's not hard to see why many of these large investment groups are setting their sights a little bit lower over the coming decade. US share prices look expensive, especially compared to historical standards, and interest rates are still being carefully managed by the Federal Reserve in the US because the central bank is walking a tightrope between growth and inflation. Meanwhile, economic growth in other developed markets is facing headwinds. You've got ageing populations, you've got productivity growth, which has become harder to achieve. Now, let's hope that AI can turn that last concern on its head. It's not all bad news. In contrast to shares, return expectations for more conservative assets have become more encouraging based on the survey. So respondents are expecting US Treasury bonds to deliver 3.6% per annum over the next decade. Now that might sound pretty subdued, but remember that in the last decade, Treasury bonds have returned just 1.4% per annum. And only 3 times out of those 10 years have we seen a return that has beaten that forward estimate of 3.6%. So global fixed income has been disappointing for many years. It's offered very subdued returns, and those have barely kept pace with inflation. But that has changed because interest rates have lifted themselves off the floor, and they are now offering income-focused investors some breathing room. Another area where return expectations still look healthy is in the alternative assets space. And alternative assets includes a whole range of things: private equity, private debt, infrastructure, commodities, gold. And this survey suggests that some areas of that alternatives landscape, such as private equity, could still deliver returns that are north of 9% annually, while private debt and infrastructure are expected to offer 7 to 8% annually over this next decade. So those types of assets are no longer the domain of the uber rich. Regular investors are able to get an exposure much more easily, and that is where you might get some better returns if you're looking to squeeze a bit more out of your portfolio against that backdrop of a more expensive US share market. Now, something else that I found really interesting within this survey, and particularly valuable, is what it tells us about uncertainty and the limitations of forecasting, because the firms that are involved in this have armies of analysts and number crunchers and strategists and infinite resources at their disposal when it comes to trying to figure out where the world is going. However, you still see a range of expectations, quite a big range too. Some are predicting returns that are more than double the estimates of others for the exact same hypothetical portfolio. Now, that won't surprise anyone who's been involved in financial markets, because markets are inherently unpredictable. And anyone out there who claims to know where they'll go next is almost certainly trying to sell you something. Be very wary of anyone who believes very strongly that they have the ability to tell you where the market's going, particularly over the short term, but even over the medium term, it can be difficult. Now, what we can say with more confidence is that the consensus points toward more modest returns than we've become used to in recent years. That's not something to get too despondent about. It doesn't mean that opportunities don't exist. They certainly do. All it means is that the easy gains of recent years might be behind us for now, and investors will have to work harder for their returns. We're all going to need to pay closer attention to fees and to costs. We're going to need to be more discerning about investment options, and most importantly, we need to keep our expectations on the ground. So the investor out there who is expecting a 10% annual return and taking excessive risks to chase that return might well come unstuck, or at least come away disappointed. In contrast, the investor who is planning for 6 to 7% returns and is simply building a sensible, diversified portfolio, they are much more likely to achieve their goals. That should still comfortably outpace inflation, and at 7%, you'll still double your money in a 10-year period, so it's not a terrible outcome. I think the key takeaway from what I've spoken about today is that we just need to recognise that we might be entering a period where patience and discipline matter much more than market timing and stock picking. All right, thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.